Hi, this is Curtis Hawks, Executive Vice President and Chief Marketing Officer with Insurance Agency Marketing Services. And I'm very pleased to have with me today Mr. John Salomon, who's going to be giving us some good insight and good information on some recent changes that have gone on in the marketplace specific to Universal Life and Indexed Universal Life. Um, as many of you know, if you've been in this business any amount of time, change is constant. Whether it's in the annuity space, investments, life insurance, there's always going to be changes to product. And when that happens, that creates significant opportunity for advisors that are in the know and understand what those things mean to craft the best solutions for their clients. To give you some background on John, he is the president and founder of Optima Financial and Insurance Services, and he's been in the business for a very long time. And I can tell you, I've had the pleasure of working with him for over 10 years now, and he is one of the most knowledgeable minds I've met when it comes to the structure of life insurance products, and especially indexed universal life insurance. So John, I really appreciate you taking the time with us today to give us some of your insight.
Thank you, Curtis. Let's just change that 25 to 32.
There you go. Yeah,
over 25 is correct.
Okay. I know we've worked together for a long time, and what I would tell the audience is I don't know in that time frame that I've ever called you and you not known the answer to a question. So I know you've got I don't know how you keep it all straight and keep up to date on everything, but some way
Thank you.
you're able to do that.
Let's not set expectations too high, Curtis.
There you go. So first thing is, I think probably people started to see some stuff in the news about AG 49 going back to last year, and probably started to see some of the emails from the carriers talking about cutoff dates for submitting applications and all of that. But could we go backwards and kind of give us kind of a high level background of what AG 49 is and then what this most recent iteration is?
And yeah, absolutely. And the reason we have all this talk in the media and talk in the marketplace right now about AG 49 was because what happened before. Let's go back to the birth of index life. And I like to use the word underregulated. We were regulated, but definitely not enough. I remember getting upset with what people were selling. And that was one of my biggest opportunities for recruiting, was to say, let me see the last thing that you illustrated. And there was many companies that had these 17% caps and had these ridiculously low interest rates. And they were showing 4 and 5% arbitrages on the loans. What did that mean? To break this all down, they were literally showing 16 and 17% distributions on their index life illustration. So fast forward, and it was ridiculous what was happening. I worked for a big company. I worked for a company called Ameris. And it seemed like we were, not constantly, but we did make some changes to how we would come up with our illustrated rate. For example, company A may have a 14% cap, and they were illustrating at 8.75. Someone else had a 13% cap, and they'd illustrate higher. There was no uniformity. So AG 49 came across to put some kind of a limit on what they can do and just create a little bit of a level playing field, if you will. Obviously, it backfired with what happened, but I think that the biggest issue was the underregulation. I mean, a great example. One of my slides I had back in 2001 was a picture of an Indianapolis race car with 2 engines. The engine was the IUL. The second engine was the loan. You could go invest it. Obviously, compliance finally got a hold of that one and squashed it, kind of like hyperfunding nowadays. Yeah. But the whole idea was there was way too much upside potential in these things, and it just wasn't accurate. So we needed a change. So that's kind of how AG 49 started. You remember those days, Curtis, don't you? That's kind of when you were just starting.
Yep.
Yeah. And so the fact that we needed some uniformity, and what ended up happening was we got AG 49, and AG 49 came in, and I think the idea was to create uniformity and try to levelize the playing field in respect to the illustrated rate. And now that I'm going through this in my mind, it's just interesting to me to think about what really happened. And those illustrated rates were not defined. AG 49 was literally 3 pages, well spaced, and left for just an amazing amount of interpretation by actuaries. And if you take a look at some of the webinars and some of the training that I've done with you guys, and we talk about what these carriers did to really turn things loose, it was quite amazing what some of them did by allowing their illustrations to just scream through the roof. And what do I mean by that? If you take a look at what AG 49 did, what did it try to do? It really wanted to say, hey, we're going to get rid of those 4 and 5% arbitrage opportunities on the loans. We're going to really restrict how we can illustrate these things in terms of, hey, if you have a cap of X, you're going to illustrate it at Y. And actuaries got creative and they sharpened their pencils. I think it's a good way to look at it. And I do a PowerPoint where I take these top 10 companies and I literally show what happened with AG 49. Obviously, we were restricted by what you can do with the illustrated rate. So if we were all of a sudden going to take an illustrated rate and lower it, what companies did was actually increase the fees to buy these bonuses and buy these multipliers. And again, Curtis, we want to keep this at 50,000 feet, right? We can go into a lot more detail with future trainings, but the whole idea was this. Let's go take an illustration. And if we have a lower illustrated rate and fees went up to cover some of these bonuses and multipliers that were the sharpening of the pencils, if you will, it just doesn't make any sense that if interest rates go down, illustrated rates go down and fees go up, how can distributions possibly go up? And that's something that I spent a lot of time training on, was just making sure people truly understood the inner workings of these policies, because they turned out to be, it was my pet peeve. If somebody called me up and say, hey, John, can you send me ABC and XYZ company? I wanted to say, what are you going to do with it? It's really difficult for agents to understand by reading an illustration which policy is better. It doesn't explain every nuance. It didn't show what the actual multipliers were applied to. It didn't show many different opportunities inside these policies and how to compare them. The most important and the biggest hole, to go down a little bit of a rabbit hole, I'd love to go off on tangents even while recording, is did it make any sense to have interest rates go down, to have fees go up, which meant distributions went through the roof? That doesn't make any sense. The other thing that was counterintuitive to reality was, did it make any sense that if I was illustrating a policy at 7 and I had a loan rate set at 5, right? We all understand we want to borrow money. Curtis, if I say to you, do you want to borrow money at 5 or 6%? What's the answer? Not a trick question.
Yeah, absolutely.
Yeah.
In the context of life insurance, yeah. I mean, you look historically, those rates have been at 9, 10, 11% on loan charges.
Yeah. And the idea is, if you took a loan charge and you went from 5 to 6, you raised it. Not as good for the client, but the illustration looked better. There were so many holes in this regulation that just didn't work out. And it created a lot of room for actuaries to do what I despise in the industry. They absolutely allowed you to create the best illustration to the detriment of the client. My favorite line has always been, I'll say this 3 or 4 times in this next 20 minutes. Do you want the best policy or do you want the best illustration? Probably a little more information. We can edit this thing.
Yeah,
anything you want to add to that, Curtis?
No, I would agree with you. And I think, we've had a couple of things. One, with what the illustrated rates are, and then the loan arbitrage. And so we've had a couple of rounds of AG 49, and that really gets me into the next question that we have up, which is this most recent addition to it, right? There's additional changes that are going on with IUL policies. And so what's the most recent update that they've done that went into effect last year?
So what they really tried to do was reel in what was happening. Because if you think about it, the big question was really, what is the crediting rate on these policies, right? If I'm showing you an illustration of 6%, and I go to the charges and credits page, and there's $100,000, and all of a sudden you see $15,000 in credits, that was the biggest issue with AG 49, was these crazy multipliers, these giant crediting rates versus illustrated rate, right? There was a gigantic difference between what you saw at the top of the page and what you got credited to your policy. And that was apples and zebras. It didn't make any sense. So I think the regulators were a little upset with the industry and what they did with AG 49 by creating multipliers, by creating bonuses, and circumventing the intent of the rules, probably a good way to look at it. So they finally said, here we go. We're going to put something in writing that's really difficult to circumvent. And instead of having a 1% arbitrage, which nobody held to, they said, hey, the difference between the illustrated rate and the loan, if you will, has to be held to 50 bips, right? So if they did something like that, they would really restrict what we could show in terms of distributions. Because even with AG 49, As I mentioned earlier, in our underregulated time, we were in the 15 to 16% distributions. We were still showing 12s and 13s. Some companies were still at 15. And the idea was to bring that back down. And I like to think of it this way. On a wash loan, we're probably at 6 or 7% of cash value as a reasonable number that you can pull out. For example, if you have $1 million at age 65 and you use in a wash loan, you can pull about $60,000 a year. Is it realistic to say I can pull 150,000 out using these arbitrages and get these things to be super aggressive? Absolutely not. So what AG 49A came along in mid-December and said, we're really going to restrict you to 50 bips. And more importantly, we're going to regulate how you illustrate these things and keep a very sharp eye on the illustrated rate versus the crediting rate. And that's the big pullback, if you will. And so we've gone from, do you want the best product or the best illustration and talking about how we're going to price these products. We've gone from that kind of an area of free will, if you will. These actuaries could do whatever they wanted with these bonuses, with these multipliers, and really make some pretty interesting illustrations. And now they've been reeled in quite a bit. And you'll see these new distributions post AG 49A drop anywhere from 20 to 50%, depending on how aggressive you were in the pre-AG 49 era, which companies you were using that may have gotten those 14% distributions. They're the ones that really are going to get reeled in. And I think the big thing now is, maybe jumping ahead a little bit here, when I think about what the regulation's done, I've always said, do you want the best product or the best illustration? Because they're not the same company, they're not the same thing. Well, now my new line is going to be, talking about these products now. The best opportunity on the illustration is not the best opportunity for the client in the long run. What am I saying? Picking a certain bucket to illustrate versus which bucket's going to work best for the client are definitely different things. And my new line for 2021 is practically guaranteed. You are literally practically guaranteed that if you run the illustration in the best light for the client, it's not what's going to work for them in the long run. I hope, does that make sense? Did I say that? Do we need to edit that, Curtis, and make that a little clearer?
No, I think that makes a lot of sense. I think for a very long time in the IUL space, um, you allocate your indexes, you look at your rate of return on there, and you illustrate that. And this change, you make the point about illustrated versus credited rates, right? The cash value isn't going to necessarily reflect all of the accumulation inside the contract. And so you've really got to, I think, be a lot more deliberate about it. It's not so simple as just pick annual point-to-point S&P 500 and run with that on all your designs. I think you really got to look at how is the structure of the product and what we think is going to happen going forward.
And the tough thing is, when an advisor calls me and says, hey, can you send me these two carriers? I still want to say, just tell me what you're going to do. What are you really going to look at? My favorite way to explain this to an advisor is say, look, there's not one moving part. There's not one aspect of any index product that makes it better than any other one. Don't call me and say, hey, this company's got a 22% cap on the S&P 500. This company's got a guaranteed loan rate of 3%. This one's got 22 triggers on the riders. There's not one thing that makes these products outperform anyone else in the market. You have to look at the whole product and really understand what's happening behind the hood. And very few advisors understand what the actuaries did, how they priced them. Very few even understand that there's a difference between an IUL designed for death benefit, there we go, and one that's designed for accumulation.
Well, and I think that really goes back to it's tough. I mean, an advisor out in the field, you're an entrepreneur, you're running a business, you're doing marketing, you're doing all of these different things out there. And I think that speaks to the importance of having a good marketing team that you're working with, to where that's what their job is. They're supposed to be in tune with how these things are designed. So you can go to that marketer with, I've got a guy, I've got a case, here's the parameters, and trust that they're going to come back with what the best solution is for that client.
Absolutely. And that's, to say education is key, that's an understatement. We really need to make sure advisors understand what the actuaries did when they created these products. Think about, Curtis, the four companies, I don't want to name them by name. You understand the four that were really egregious with the difference between the illustrated rate and the crediting rate, right? They had these crazy multipliers and these crazy fees, right? If you have an asset-based charge in a fixed product of 4, 5, 6%, is that a fixed product? Do the clients really understand the downside there? No way. So I just want to make sure that, we want to be able to educate people. This thing we're doing here is going to maybe worry them a little bit, which is great because we want them to come back to get the information we want to give them and show them how how each company has designed their products and which ones we think illustrate really well and which ones should perform really well. Because again, there's not one moving part that should say, hey, I want to go sell that company. They got a 22% cap, whatever it is.
Yeah, no, I think you're absolutely right. Um, when you're moving, you're shaking your camera.
Ah,
When
I know I
you're, I
get
don't
all
know if you
fired up.
put your hand on the desk or either when you move your
I
hand.
put my hand. I got my hand a Veridesk. I've raised it up, so that's good.
Okay.
That's good feedback. So how much did I screw up that whole thing?
No, it's just a little bit, but there's a couple of times where it shook pretty decent, which we can work through that. But I'm just giving you a heads up for
Okay.
the rest of
You can
this.
tell I'm getting excited about it. I get all fired up.
Yep. All right. So we'll pause for a second, then I'll get into the next slide.
All right.
So that kind of leads me, yeah. So that leads me into next question we have, which is 7702. Now, as I mentioned, the carriers were sending emails out about AG49 last year because the illustrations were going to be different post AG49 that went into effect. 7702, I think the majority of the advisor base out there is not familiar with what's going on with this. And I think it's because the industry as a whole really didn't. This was legislation that was out there, but I don't think anybody expected it to come through. And then it kind of snuck into that last stimulus package. So I think even the carriers
No
are
one
getting.
expected this to be slammed on top of the Heroes. The Heroes Act. That's
Yeah.
for sure. This was, I've had a couple epiphanies in my career, and this is an interesting twist. I'll throw this out. This is how my mind works, Curtis. I was trained as educated. I have a degree in finance and I minored in econ. And my teachers, my professors were big fans of modern portfolio theory. So I had a hard time accepting life insurance as an asset class when I really got going in this industry until a couple things happened. If I look at what happened in 2007 and 2008 and the crash, that was a big deal to me. When the whole market just tanked, everything tanked. No matter how well diversified you were, you lost money. If you were in one of these products, you wouldn't have lost money. And that really helped me understand, hey, maybe this could be a little bit more than just a bond-like portion of your portfolio. This should be a significant part, depending on your risk tolerance. That was a watershed moment for me. This one's bigger than that in my mind, and maybe that's not big to everybody there that I go hitting my desk again. The idea that we can now put twice as much money into a policy as we could December 31st is just insane that this got slammed down our throats so quickly. And in a nutshell, I guess I should take a step back and explain what happened.
Yeah.
If we really want to get into it, that's probably a 45-minute presentation. But to say what's going on in 3 or 4 minutes, back in the 80s, when 7702 was designed and CVAT and GPT were created for understanding how life insurance works and how it doesn't work, defining a MEC, if you will, they were assigning a couple of interest rates that were fixed, 4% for CVAT, 6% for GPT. And those got lowered December 31st. And it was a major shakeup to the industry. And to make a long story short, if you think about a whole life policy, if you think about it at the base premium on the guaranteed side, you put a premium in there, and that is the premium that you have to put in there at that age to make the policy endow at age 100, to make the cash value equal the death benefit. And if all of a sudden we're taking that 4% guaranteed rate and now making it 2%, we can stick a lot more money in there, right? That makes sense, right, Curtis? You track that?
Yep.
Pretty straightforward. And now take 7 years of that premium. In a nutshell, I mean, it's a very loose definition, but that's what the MEC is. So now we can put a lot more money into these policies and not violate the MEC. So it's a major issue. It's so much bigger than we all think because there's a huge balance in the offerings that we can give to the client and that we can give to the advisor. There's a value proposition imbalance. I love saying that. I just heard that this morning in another call that I was on, so I'm throwing this out for the first time. If the clients are going to get anywhere from 25 to 40 bips more in their internal rate of return on these products, and that's so far the first examinations, that's what we're looking at. But we could potentially cut the advisor's commissions in half, right? So think about what I just said. If someone's got $1 million policy and they can stick $50,000 into it, well, now with this new rule, if this person's 45 years old, they can probably stick $100,000 into it. Sounds great. More money in, less fees for the client, going to make more money. But think about the inverse of that, Curtis. The inverse of that says, hey, we don't have to sell them $1 million. we can drop it by 50%. So their internal rate of return, maybe best case scenario, goes up 40, 50 bips, right? But we just cut our commissions in half. That's a severe imbalance. The carriers understand that, so they're going to struggle with that. To me, they're all waiting for the other ones to lift their skirts, so to speak. No one wants to jump in the pool first. They're going to wait and see what other carriers are doing and designing products that will work for it. But for right now, the products haven't changed yet. One company is coming out. They've announced April they'll make a change on their product. Other companies are going to wait and see what happens. But for right now, we're in kind of this gray area where we'll continue using the same policies. If someone demands that I can put more in, the law says I'm going to be able to do it. Who knows what the carriers are going to do? But for right now, it's just it's an unanswered question. So it's kind of a gray area. The good news is, as I mentioned earlier, if you were illustrating these policies with a quality company and not showing absolute best case scenario, AG49A didn't hurt you very much. Maybe 15 to 20% of distributions, but it's only an illustration. Remember, that has nothing to do with reality on the actual contract performing in real life. This gave us some of that back, and especially when we talk about premium financing, right? Anytime we can pick up a quarter to a half a point, 40, 50 bits, whatever it is, it's an awesome opportunity to just make that leverage work, right? Because the whole idea of premium financing, I'm going off on a rabbit hole, you can edit this, but the concept to me is let's borrow at simple interest and let's outperform it with compound interest. And that compound interest just got a little bit back that was taken away back on December 14th.
So, in your opinion, then, I mean, you are pretty much forecasting that we're going to see new product rollouts and significant modifications. And if I heard you correctly, it kind of sounds like right now they're trying to figure stuff out and seeing who's going to jump first so they can start evaluating each other's products. Is that kind of your general sense at the carrier level?
Well, I want to be really careful. We're recording this. It's going to be sitting out there, right? And then someone's looking at this, God, that guy was an idiot. And so the idea is companies don't know. I mean, we could literally, and if this isn't right, then I'll really look foolish, but we could see a complete change where the whole concept of a target premium goes out the door. Maybe they'll just pay on total premium. Maybe they'll redesign products and raise targets. We don't know which way is going to go, which way the carriers are going to go. I think that when it first came out, when you and I were first chatting about this, Curtis, my initial reaction was, wow, if we can stick twice as much money in, this is going to be amazing. This is going to make premium financing. This is going to make, life insurance as an alternate for, just, I guess I'll just say retirement planning. It's going to go through the roof, but it's really not that big of a deal. The bigger deal is that it's going to really change the corridors on CVAT and GPT. We've always said we can buy a lot less insurance with GPT. That's why it works better. That's why IUL has a significant advantage over whole life because they use CVAT. But now we're going to see some interesting changes to the corridor on CVAT. That corridor just got smaller. In other words, for every dollar of accumulation value inside a CVAT policy, they can buy less insurance. So we'll wait and see what happens. I don't have any predictions. I know some carriers are leaning towards looking at just recreating a whole new product, not giving all this opportunity to the client at the detriment of the advisor. They understand distribution, is going to go away if we're all of a sudden getting paid half.
Yeah. Well, and I think that that probably gets us into, we're already kind of talking about this, but as far as trends go, you've mentioned a few different things, maybe making some changes to how commission pays out on the product. You've mentioned changing some of the bonuses and those types of things. What other trends do you think we'll see from a product standpoint this year?
Well, I kind of went down the trail of premium financing already. And I think that what's going to happen there is we're going to see an opportunity to pick up what we may have lost back in December, right? A lot of the people that I've been chatting with are saying, hey, this doesn't even work really well up, in the age 55 world. And most of the business is coming from, people up in that upper late 50s. They're the ones with the money. They're very interested in getting insurance. This little pickup will help considerably. And on those monster cases, maybe we'll just take a reduction in comp. I don't know. But when it comes to supplemental retirement planning, this is going to help quite a bit if we're competing with other dollars. And remember that, as interest rates come down, what's really happening in the industry with the upside potential, those things all come into play. But that's a level opportunity for the entire field. The opportunity cost for these dollars for the same money you put into a life insurance premium versus other places, all of those things are hurt I would say on a level playing field. So I'm just thinking about this question, the idea that who it's going to help, what's going to happen. I'm really happy about the idea of premium financing, just because it's going to pick up what we lost with AG 49A back in December.
One popular feature that a lot of advisors and a lot of consumers like on these products is we talk about living benefits, and I know the majority of the time in this conversation we're talking about it in the context of cash values, but um, a popular feature is the chronic and the LTC riders that are on these products. Do you see AG 49 or 7702 driving any change in those types of riders, or can you speak to that a little
It's
bit?
Yeah, it's an interesting question. So one of the things I was thinking about, and I wanted to reach out to one of my favorite companies. I bought for my wife and I a long-term care policy disguised as, it's a hybrid product that's a second to die policy, long-term care. This is going to help their pricing. So I was interested in that. But just in general, on the index life policies with the chronic and critical illness riders, but the first thing that comes to my mind anytime someone asks me about these, Curtis, it makes me nervous because every time I talk to an advisor, no matter what you and I do to train people, I can't tell you how many times I hear the words long-term care when they're talking about chronic illness. So just to go down a little bit of a tangent here, that's my pet peeve in this industry because there's a giant difference between unable to perform and need assistance with two
Right.
activities of daily living, two of the six. And that's just a rabbit hole that just drives me nuts because it happens all the time. I hear when I get on phone with advisors and their clients, so many. Don't forget the long-term care feature on this thing. We're talking about a product that has a chronic illness rider.
Right.
But the whole idea of what's happened this year to our business, it's gone through the roof. People are worried. COVID has really frightened people. Long-term care, annuities, and life insurance have absolutely gone through the roof for us. So I think this will help, and specifically the pricing with the 7702 on the hybrid models is going to help quite a bit.
Okay, very good. So, following that trend, if you're, we've got a lot of advisors watching this, and so I know a lot of them are obviously they want to know more, they want to learn more, but obviously one of the things going through their head is, okay, are there some opportunities here with these changes and what we think might happen with the products? What are some opportunities out there for me if I'm an advisor as far as how I'm positioning things and how I can generate more business?
Okay, I gave you a good pause there because we can edit this if you want.
Yeah.
I'm thinking about talking about Kaizen. Do you want to talk about Kaizen? I think that's the greatest thing for them.
I think if you want to talk about Kaizen, I think I think reiterating some of the stuff that you've talked about already, which is, we should be able to stuff some more money into these contracts. So that's going to help us to, when we're talking about supplemental retirement income, really show some very competitive cash flow scenarios. So I would think talking about that. Um, I think instead of straight talking Kaizen, if you wanted to talk about, there's some specific premium finance programs out
Hybrid
there that
opportunity. Okay,
you
yeah,
can
okay.
reach
I won't mention it by name.
the sales
All
director
right.
over at IMES and they can talk to you about some of this stuff. But I would think, we think we're going to see some offsetting and some increases in the supplemental retirement income space. I think if you want to talk about, premium finance for executives, business owners, the way the product's structured is really
All
good.
right.
We've got some IMES has some specific programs. Reach out to a marketer over there; they can help you with that. And then, what about policy reviews and replacements? I mean, do you think that's going to be a driver this year?
That's interesting. All right, let's do that again. Well, I'll just answer. I'll go. Yeah, let me just answer that. They can just cut that whole part out. Well, Curtis, I think the answer, well, let me pause. I think the answer to that is, there's a lot of opportunity out there. We can talk about supplemental retirement planning. And I hear this word all the time, the supercharged Roth IRA, talking about using this as an alternate to 401ks, right? That comes up all the time. Obviously, this is going to help quite a bit because we're going to be able to buy less insurance no matter what happens, no matter what the companies do with that imbalance between, the client and the advisor. They're going to be able to sell less insurance. There's going to be more money going into the cash value. So obviously, that's going to help. Like I mentioned before, for the premium financing world, anytime you can borrow money at 1.75 over LIBOR with a floor of X, and where hopefully we're still going to be able to outperform that in the long run. I think that's just amazing. Right. Interest rates are so low. That's a great opportunity for us. There's some awesome hybrid financing opportunities out there we can do some specific training on. One in particular that we do a ton of. I'd love to chat about that with people in more detail. But just the whole idea of getting reeled in by AG 49A back in December was really loosened up a little bit by 7702. We don't know how much. We don't know what the carriers are going to do. It's an open-ended question. You asked that. If I had a crystal ball, I could tell you. I don't want to say anything
Right.
stupid and guess at anything. And so you call me back in 6 months and say, remember when you said that? No. Don't want to go down that rabbit hole.
No, absolutely. And and that's why I'm glad that we've got you on the call today because, again, as I mentioned at the very beginning, you've got a lot of good insights. But I think one of the really neat things is you really are connected at the carrier level, and so you've really got your finger on the pulse of what's going on, what we think is going to happen, and what the products are going to look like, and then how to structure them the right way. And so. One thing I'd mention to everybody that's watching this is, John, to your point, it's kind of an evolving situation. All these things are really, really new. Carriers are still trying to look at what modifications they're going to do on the product. And so we are going to be kicking off a 3-part series with you. I know you had just a little bit of time today to spend with us to record this, but we're going to be planning on doing a 3-part series with you, which we're really excited about, where we take really a deep, deep dive into AG49, 7702, and really optimal design in the IUL space and how to really maximize that benefit for the client and show people how to generate max leverage yield and really get those funds into a tax advantage position. So
I'm looking
um,
forward to that, Curtis. And I want to educate people because I'll say this probably the third or fourth time. The best illustration is not the best product. I want to show people the inner workings and hidden mechanisms in these policies, how they're designed, what the actuaries had in mind, what they're trying to target. And it's important. One of the things, as you mentioned, that I'm connected. I like to talk to the actuaries. Some of my best friends are my connections that are the regional guys running around. But they know a lot, but the actuaries know more, and that's why I like to go to the
yeah.
actuaries to get my information.
Well, you're absolutely right. I'm glad that one of us is in tune to that at the level that you are. So I just have to pick up the phone and call you, and I know what's going on with all the carriers. So,
There you
but
go. All right.
in any case, what I tell everybody is be on the lookout here over the next couple of weeks. You'll start seeing some emails and marketing going on with when we're going to kick off this 3-part series. But it's going to be some really, really good information. And hope you guys enjoyed the video and are enjoying the Ascend event. Thank you.
Hey, edit this.